welcome back to my channel. My name is Sophie and I'm a third year computer science and Master of Management student at the University of British Columbia. And today is really exciting because I got a ton of great feedback on my last video about investing and kind of the one thing you should do as a student. Link below and somewhere around here. Go check it out if you haven't already. But a lot of people said that video really motivated them to want to start investing, and that made me really happy. But I got a lot of messages asking or saying that they were motivated but they didn't really know where to start. So this is that video that you guys have been waiting for. So this video provides the fundamentals and the kind of framework that you can follow when it comes to investing to make the whole thing seem less daunting, less stressful, and less overwhelming than it currently is for you. I'm going to be going over what a portfolio is, how you can decide which companies to invest in, and also how you can let other people decide which companies you should invest in. In order to make all of this information really accessible to you guys, at the end of this video, I'm gonna kind of create a cheat sheet kind of thing. And I'll put that up on the screen at the end of the video so that you guys can take a screenshot and just have this kind of cheat sheet that you guys can refer back to when you guys actually start out on your investment journeys. Also, watch till the end of this video because at the end of this video, I'm going to share with you a way that you can get money for free essentially. So my goal with this video is to make you feel more comfortable when it comes to investing, give you the fundamental skills that you need when it comes to investing, and most importantly, give you an objective view of what investing actually is. So let's jump right into it. So the first step is to put roughly 10% of your monthly earnings to the side and not touch them and only use those for investing. Then once you have done that, you've put that money on the side and you're not touching that money, the first thing that you need to know is what a portfolio is. So your portfolio is the companies whose stocks that you own and how many of those stocks, as well as their current price or the total price that they're worth within your portfolio currently. And a good estimate when you're really starting out is that you want roughly 85% of your portfolio, so of all of your investment assets, to consist of stocks and roughly 15% to consist of bonds. If you want to know more about why, I'm not going to get into that in this video, but check out the series that's going to be coming out very soon on this channel about the 5 different ways that you can invest. One thing to really keep in mind with your portfolio is that you want to diversify your portfolio. You've probably heard these stories of people investing and then losing a ton of their money. Well, that's because they're not investing smart. They're investing a lot in the same company, they're investing a lot in the same industry, so that if something bad happens to that company or industry, essentially, all their money's gone. So you want to diversify your portfolio. So what does that mean? Diversifying your portfolio essentially means that you want to invest in small cap as well as large cap companies, preferably of different industries. Small cap is a company that's kind of starting out and its value isn't that high yet. And a large cap is a more established company whose asset values in the stock market are much higher. The cap of a company is essentially the total kind of amount that the company is worth based on the amount of shares that they're selling or the amount of assets that they're selling and the price for each one of those assets. Once again, the most important thing about your portfolio is that you want to diversify it, which leads to more security. Now let's move on to how to decide which companies to actually invest in. The most important document that you need to know here is a company's balance sheet. And on that balance sheet, which is a document that you can find on the internet for any company really, you will find the total amount of assets and the total amount of liabilities. The total amount of assets are essentially the total amount of resources that the company owns. The total liabilities are essentially a future economic sacrifice that has to be made due to past transactions, and this is usually in the form of debt to another economic entity such as a company, for example. And there's 2 main kind of ratios or numbers that you want to look at here. One of them is the debt ratio, and the debt ratio is the total number of assets of a company divided by the total number of liabilities of a company. And you kind of want that to be less than or equal to 2 or even better 1.5. Because the higher this number is, the more kind of insecure the operations of a company are. And the second number that you want to keep in mind here is the shareholders' equity. The shareholders' equity is the total number of assets minus the total number of liabilities. So this represents the money that shareholders would receive after the company has paid off all of its debt and kind of liquidated all of its assets, which basically means turned them into cash. You want this shareholders' equity to be less than or equal to 1.5. So once you've got all of these super interesting numbers out of the way, another thing that you want to keep in mind is, well, you want to invest in a company that you think is going to do well in the future. So how do you know now whether a company is going to do well in the future? Well, you want to think about whether you think that that company is going to increase its revenue, which is essentially the money that it's making. How do you know if a company might get an increase in revenue? Well, there are 4 things that you might want to keep in mind here. A company can increase its revenue by increasing the prices of its products. You want to keep an eye out for increasing sales figures. You also want to keep an eye out on decreasing expenditures. You also want to look out if the company is selling off or closing down any unprofitable subdivisions, for example. When it comes to deciding what stocks to invest in, the main error a lot of people make is that they spend their time reading the market. They look at, oh, how is this stock doing in the market right now? Is it increasing? Is it decreasing? What's happening in the market? That is not what you want to do. Rather than spending time looking at the market, spend that time looking at the company. You want to know the company inside out. You don't have to know the market inside out, because beating the market is a very, very tough game to play. But if you know a company inside out, you know its history, you know how it's probably going to do in the future, you have some kind of idea, and you really know how it's doing today, on this day, then you know the company. And if you know the company, then you know, or you get a better understanding of whether this might be a good or a bad investment. So if all of this sounds a little bit complicated to you and you don't want to go through the hassle of kind of having to decide yourself which stocks you want to invest into, there is good news for you, because you have 2 options here: index funds and mutual funds. First off, let's talk about index funds, or ETFs. ETFs are essentially a pool of assets, stocks and bonds, for example, that are pooled together and have kind of rules imposed on them in order to track a certain market index. And that means that it's automatically managed. And when you invest in an index fund, you will automatically own a fraction or a piece of every stock that is part of that index fund. Because of this, index funds are great for portfolio diversification, which I mentioned previously, because they don't just allow you to own assets in multiple companies or even industries, although that is a little bit less common, but they also allow you to own different assets such as stocks and bonds. And again, if you want to know more about those, stay tuned for the series that's coming out. And index funds, or ETFs, they trade throughout the day just like any other stock on the market, and they also have lower management funds than mutual funds, which I'll come to next, because they're not actively managed but passively, as I previously mentioned, because they really try and track a market index. So cheaper management fees basically means that you're paying less than 1% of the stock price for management fees. Because of this, more of the kind of return on your stocks will actually go into your pocket. Warren Buffett himself, actually, who, I mean, you probably know Warren Buffett, he himself encourages investment in ETFs, especially for beginners, but for anyone really, just because it provides that level of additional security that they're already this pool of diversified assets and stocks and bonds that will just help you truly diversify your portfolio. So now let's get into mutual funds. Mutual funds, in comparison to index funds, they only trade once a day, and that's when the market closes. And stock markets are open 9:30 a.m. to 4 p.m. Eastern Standard Time. That basically means that within that time period, stocks and ETFs can be traded, and once 4 p.m. passes, only then is the price of mutual funds kind of determined, and those are traded. Obviously, this means that there's less opportunity for you to buy mutual funds. In addition to this, mutual funds have higher management fees because they are actively being managed by professional managers, and that's because it's a pool of money that's collected and invested in various different assets and stocks and bonds, as compared to index funds, which are already kind of adjusted to a certain market index and can therefore automatically be managed. So a higher management fee in this case means up to 3%. So just to summarize what we've gone over today, one thing that you really want to start off with is just every single month, put 10% of your earnings onto the side, don't touch them, and just use that money for investing. When it comes to your portfolio, you want roughly 85% to be stocks and roughly 15% to be bonds. When looking at companies, you want to keep in mind the balance sheet and the debt ratio, as well as the shareholders' equity. And most importantly, you don't want to study the market, you want to study the company. If you're getting into investing or you're already a seasoned investor, you want to really focus on diversifying your portfolio, and index funds are a really great option to do this. If you're not looking into index funds and you kind of want to go on more of an adventure and want to find your own companies to invest into, keep in mind that you want to invest into both small caps as well as big caps in a diverse variety of industries. So now let me tell you how you can get started on actually investing and how you can actually get some free money. So in the description below, you're going to find a link to Wealthsimple, and you can set up a Wealthsimple trade account, which allows you to trade stocks with zero commission, and you get free money if you sign up, but only if you sign up with the link in the description below. So go ahead and do that. As I mentioned in the beginning of this video, I got a lot of positive response on my previous video that I made about the one thing that you should do as a student. I'll put the link in the description, and you should really check out that video if you haven't already, and I'll also add a link to a playlist that I'm kind of starting to create with a bunch of finance videos that I'm making. And again, go check that out. If you found this video entertaining or helpful in any way, shape, or form, leave a like, subscribe, hit the notification bell, and share this video with anyone that's kind of motivated to invest, but that's just overwhelmed or insecure. And yeah, just try and kind of push them into the right direction. Take care, and I'll see you soon.